Good morning, ladies and gentlemen. Well, by my manual calculations, we are positive in the risk dial indicator for the very first time since the beginning of the year. And therefore it indicates a continuation of the risk on trade now. Let's have a look at several reasons why that might be the case and what might act to stop it. I don't think it's going to go very far to start off with, but it paints actually a very good picture for the last quarter of the year. What happened in bonds last week after that CPI number, which was lower than expected, but which indicates that inflation is not actually falling. It indicated that the pace of acceleration of inflation has stopped. That was obvious because of the fall in oil prices. And so really it would have been, a bit ridiculous to expect inflation to be accelerating. The fact that it's stable at higher levels, I don't think it's what the Fed wants. I think the Fed wants a falling rate of inflation as a baseline all the way down to 2%, and they've told us that several times. While the present situation is encouraging, it's certainly not the end of the road. And their dot plots and their rhetoric suggest that they are going to hike beyond neutral. Then are going to go into the 3.5% to 4% range of Fed funds. But the pace of the increases after two lots of 75s is going to moderate, which is normal. They've got us to neutral at 2.5%. They think neutral is around 2.5%. They're going to get us to the 3.5% to 4% in 50 basis point increments, probably 2 50s by the end of the year, and maybe another 25 or a 50 in the first part of the year. And then they're going to stop there for several months and see what the data indicates. That is what data dependence means. So what is the yield curve likely to do? Well, it's certainly not likely to disinvert and go into positive territory, I don't think. The question is how negative it gets. We got to the minus 50, which was my target, and now we're backing off a bit, and it would be normal that we now just wiggle around the sort of minus 20 area to minus 50 area, depending on the data. That is what I expect to happen in the 2s, 10s, but I don't think the 2s, 10s are the important one. I still think the 5s, 30s are far more important. If we look at what the 5s, 30s did on a weekly basis, they did absolutely nothing. They came in, 2 basis points, indicating absolutely nothing at all. I still think that this level here, around 11 basis points negative, is going to be very, very key. Goes through there, it goes another 30, 40 basis points. This swing level of 20, minus 20 is important, but it just keeps on going up and down, up and down. To me, this is consolidation before we go back, through this 11 area. And a more negative yield curve. Now, why would that be the case? That would be the case because the bonds are going to anticipate some kind of, no other way to put it, but not a soft landing. I just cannot see that the odds of a soft landing are that high. But the stock market is saying that they are being repriced. They're being repriced much higher than we have been assuming. But the yield curve is absolutely not saying that. The yield curve, if the odds of a soft landing were high, would be, getting more positive, and it's not. So I am not agreeing. If you look at what the fives, tens are doing, they're basically getting to the most inverted of the whole move. So people think that inflation is going to be higher for longer. If if people thought that inflation was going to come down in the next couple of years, that price would be falling towards these support levels, and it's not. It's going up. Therefore, the bond market seems to not agree with what the stock market is doing and repricing things. So we shall see who is right in the longer term. But at the moment, there is no question that the stocks are repricing, and of course, I'll cover that in when I do the equities. What have the individual tenures been doing? Well, not a lot is the answer. This is the daily chart of the twos. 1, 2, 3, 4, 5 days in a very tight closing range. So basically they're trading 320 what you want to do. And why would that be the case? Well, I think the market is beginning to agree with what the Fed has been saying. The Fed is going to hike 50 in September, taking the Fed funds range to 275 to 3. Probably another 50 in December, taking the Fed funds range up to 3.5. That is the terminal rate of twos tends to be the top of where the market is going to be, and that is roughly 350. So we are in a range. We're in a range between 290 and 345, and we will probably remain in that range for quite a long time. There is no reason to suspect that the Fed is going to accelerate what it says it's going to do, and there is no reason to believe that it's not going to deliver what it's saying it's going to do. Therefore, the short end of the curve is going to remain stable, and really the yield curve is going to swing around the twos portion. The twos are just not going to move very much. If the data is really, really good on inflation, they might come off 10, 15 basis points, and the data is very bad, they might go up 10 or 15 basis points. But it's not going to be the driver of the curve. The driver of the curve is going to be the back end. Here we have the fives, and really you can see how the ranges are compressing. To me, I think the likelihood is that the ranges compress further and further. I just can't see the fives going through this 3% area and staying much above it. We're much more likely to get this kind of behavior just sideways in a 20-point range. That is why I'm short of puts up here, because we didn't get the CPI acceleration, we got the deceleration. There is no reason to expect that we need to have a positive yield curve around the 3 to 3.25%. You saw the twos are stuck. I think the fives are going to be stuck too until we get some data. That basically argues with the fact that rates are going to stay much higher for much longer. At the moment, the market is pricing in a hike in terminal rates to around 3.5%, just like the Fed said. And then the question is, how quickly do we need to fall back from there? As long as fives stay around the 3%, that is basically telling you that the market expects at some stage inflation to be brought under control, whether it's in 2023 or late 2023 or early 2024, and then that rates should start moderately falling. So that is what the market is saying, and I just can't see how you can argue with that at the moment with the data that we have. Therefore, this area around 3, I think, is going to be very difficult to break. the tens are the ones that really could come back a bit more to around the 298 area, but really very tough to see them going through there. I think the markets for the next 2 weeks are stuck between 273 and 298. They're going to go up and down, and sideways. The one that is more interesting is actually, let's get rid of TLT. This is the bonds, and the bonds basically are saying much the same thing as everything else. We are between 294 and 319. Now, what we need to see for the curve to get more negative is actually, because twos and fives, I doubt they're going to do very much. Either we get bonds saying no, inflation is a problem, the Fed is not tight enough and will not be tight enough, in which case we start breaking to the upside, or they're saying yes, the Fed will be tight enough and rates because this is a 30-year after all, we need to fall back to around the 271 area. To me, the hint is going to come from the long end. It's not going to come from the short end. It's going to come from the long end. And I don't know which way it's going to go. But most probably, for the foreseeable future, we have a 320-294 range, and we stay within it. Breaking it either way, I think, is going to be significant for both the yield curve and for what it will imply, and that is that the market is beginning to argue with the Fed. At the moment, the bond market is not arguing with the Fed. It's only the equity market that's arguing with the Fed. What is happening in Europe? Well, Europe is basically now waiting. It's got another 3 weeks to go until the ECB is back from holiday. And basically, the ECB will hike. I am absolutely sure of that. War concerns are easing. As you can see from the behavior of European equities, oil prices are easing. Therefore, I don't think that all the scare about the recession in Europe is basically abating. So there is no reason to look for lower yields, especially since the curve is so non-bearish. You have twos here, the shats at 60 basis points. Well, that could easily go back to 110. Where do you argue with the shats? Well, you don't argue with it anywhere else but at 33 basis points. That is where you get short. Here we are basically neutral. I would not be surprised at all if it's meandered here for 3 weeks. But at 33 basis points, you certainly argue with it. I really can't see how we can stay below that yield. And if we move on to the bobble, it's a very tight spread between shats and bobble. I would expect the bobble to go now towards the 80-95 area. I think anything down here is arguing territory. You can see how it's just unlikely to stay below 50. A spread of 20 or 25 basis points between twos and fives, I think, is just too low. The uncertainty of what might happen in Europe is just too high to justify such a tight spread. And if we look at the 10-year, the Bund, we are likely to trade again at 114. This line is at. We're likely to touch it at some stage. basically this is the arguing point. You can see that every time we got down to 79, 80 basis points, it's just unsustainable. The trend for Europe is certainly for higher, to await the decision of the ECB in 3 weeks' time. And, the French market is the one that's been clearest. I would have thought that at some stage over the next week or so, it's going to clip this 170 area, and that is where you want to be absolutely neutral. The spread between Germany and US 10 years has remained fairly constant all week, but I would bet that it would await ECB somewhere between 175 and 181 basis points. Therefore, I think that shorting bunds on a tear, and they always have some kind of a 100-point rally for no reason, is probably a good trade over the course of the next 10 days or so. The Dixie didn't do very much last week. It basically traded around the 106.25 pivot, but I think it's more likely to await the ECB, which is 3 weeks away, somewhere a little bit lower than we are now. It's beginning to break and consolidate. I would have thought the 104 to 102 area, 103 let's call it, is going to be a more appropriate level to await the ECB, because the ECB is certainly going to hike first. If we look at what Euro USD is doing, is basically trading technically. It spiked the 103.40 level. I sold some, it came back, but not huge. I don't think this is the time to be looking for euro below parity, not with the ECB going first. I think it's much more likely to trade in an ABC kind of pattern and await the ECB somewhere around the 104, 104.40 level, maybe 105, and be ready then to fall once the ECB is out of the way and we await for the Fed. So I'm not negative on Dixie. I'm trading it slightly from the short side at levels, but I think that probably around this 102.60 area, 102.26 area, it's probably a better buy for the next couple of weeks than a sell. I just cannot see that the selling is going to be now, not while it's so oversold, and not why on the weeklies, and not while we have the ECB coming up next, and while I expect bond rates between the bond rate differentials between Europe and the US to actually narrow. The screw up that is gold is actually not so much of a screw up as me not being faithful to my thoughts. And you can see that if every time you bought it just when it touched at 1709, you would have been offside for maybe a day, and then you would have made $100. What do I think? Not a lot. Since I don't think the bond rates are going to move very much, since I don't think that the dollar is going to move very much, I can't see really much upside in gold for the time being. Why would you buy it now as opposed to when it was down here? What are you looking for? Why? Is inflation accelerating? No. Is the bond market going to go significantly lower? Doubt it very much. Is the dollar going to go significantly lower? Not really. So I would have thought that this kind of trading range is really the most likely. 1830 and 1881 being the very important resistance levels. So, might it touch 1830? Almost certainly. Might it touch 1880? Possibly, but I really see very little value in gold at these levels. Copper gold is doing nothing, and therefore I don't think that that is indicating anything at all. What would indicate something to me if it came back to test this 10 area, and I think then I would be a buyer of gold against copper, and that would actually tell me that it's time to look at for higher bond yield. I mean, bond yields will go higher until then, but that would be my trigger to look for lower bond yields. So I'm looking at it, but it's telling me nothing at the moment, really. So not much to do there. If we look at what DBC is doing, and on a weekly basis, I think it's going to be very interesting to see if it can break 2693. I think 2693 might be actually a very good level to short. But the interesting one to me is on a daily DBC. It's basically climbing up the 200-day moving average. It's tried it once, twice, three times. There is certainly nothing. There are no quadruple bottoms. I think if DBC now starts falling below 24 and a quarter, it's 24.30, it's going to have a very nasty fall. And that would be my signal that long-term yields are going to decline substantially. How could DBC do that? Well, this is a monthly chart of CL, and as we know, DBC is mostly energy. Interesting here is that while DBC is above the 200-day moving average, CL is beginning to actually consolidate below the 200-day moving average. Let's try and, at some stage this turns. We could have a few spikes up to 100 and 101, but it's beginning to turn. So this is basically saying, and if you look at their monthly chart, it could easily then fall within a couple of months back down to 75, and then consolidates and 75, 100. If that is what is going to happen, then to me that is going to lead to a yield curve which is negative or very negative, because the oil price is going to be saying no inflation. Possibly it's also going to be saying lower consumption, lower production. And if that is what it's saying, then long-term bond yields can only come off. Before we look at what equities are doing and why they might be doing it, let's have a look at some fundamental indicators. This is the five-year forward inflation expectation rate, and it's basically stable around 2.25%. If we have a look at what the 10-year break-even inflation rate is doing, well, that's more or less now stable around 2.5%. It went up all the way to nearly 3% and all the way to nearly down to 30, but it's basically now stable around this area, around 2.5%. So that has meant that the term premium has got too low, and actually the term premium is going back towards zero. I just can't see the term premium staying around these negative areas. I think it's much more likely to go back up towards zero. What does that show us in terms of forward expectations? We are now at times 18. The fact that bonds are stable and forward inflation expectations are stable enables if they want to argue with a lower probability of any kind of recession, i.e. a soft landing, probabilities of a soft landing are going to make A, the multiples higher, and B, the certainty of what earnings are going to be much higher. And therefore you get this move up in both. You get the move up towards the times 18 multiple, but you also get a smaller decrease in the downward slope of the Blue Angels, and therefore a re-rating of equities overall over bonds. Are we likely to go much higher? I would argue that the Fed would be very unhappy if it saw that, and it might actually accelerate the path of tightening. That's what I would do if I was at the Fed. I would say, okay, the market is saying that the inflation is not going to be a big problem, or even that growth, the compression of growth is not going to be a big problem. Fine, let's tighten some more. Let's accelerate the tightening. Let's get to to a rate above neutral, i.e. a restrictive rate, much quicker, and therefore the odds of us missing our inflation target will diminish, and that's what I would do. So I would argue that these levels are beginning to be a bit ridiculous. But that is why they happened, because the market re-rated the possibility of a soft landing to a much higher probability of a soft landing, both an increase in the multiple and also a decrease in the downward slope of the Blue Angels. This is a daily chart of HYGH, which is basically credit without having stripped out the interest rate moves. So pure credit in a way. And as you can see, it's rallied hugely. And basically this is the re-rating in equities. I would have thought now that until and unless it drops below 83.42 again, the S&Ps are going to be bid on every dip, and this is what we got last week. We got the move up in credit and therefore the re-rating of equities, and that is why we're going up. We've got the 200-day moving average coming up soon, as we have the 200-day moving average in S&Ps, as we will see. Probably likely to trade up here, these kind of levels, and that is what should prove to be a top if we're looking for a top in equities. And when you get a re-rating in the probabilities of a soft landing, this is what happens. SPY TLT goes and tries to test the highs. To me, it's going to be very important. If it breaks these highs, there's going to be absolutely no dips to buy in the SPUs. The SPUs will just continue. But I think that that is unreasonable. I really cannot see what would make this happen now, unless we are absolutely certain of the of A, credit continuing higher, and B, the fact that bonds are going to be absolutely stable and we are not going to have any more inflation scares. It's possible that it could go straight through and continue, and that would be very, very bullish for equities. But, and this is a big but, if the re-rating is to continue, then you would expect equal weight consumer staples over discretionary to actually start breaking these levels, which have been bottoms for a long time, and start going up to here, up to the 200-day moving average, which is sloping downwards. And only if that happens, if next week we start breaking this level, which I'll tweet you about, then I would expect the S&Ps to go up another 2-3% without too much bother, because it means that that this indicator is actually approving of the re-rating. At the moment, it's not. So at the moment, we have very mixed indicators about the re-rating. We have a lot of indicators which actually are saying that this is just basically exhausting itself on the upside, and that the next move is to the downside. So on a daily basis, you really now are looking at sometimes next week for a break of the 200-day moving average and everyone getting bullish and the market getting to 43.84. 43.84 is going to be a very, very important level. You can see how many days here it was the base. And then when it finally broke through, we got a real move down. To me, as long as it stays above 40.77, 40.78, it's going to be nothing but corrections and levels that are still getting bought for a move to at least 43.84. I really don't think that you want to fight this until 43.84 and then think. On a weekly basis, that level is 43.95. That is more likely than not, and it would coincide with this moving average. Break above, consolidate, come back down. But basically what it says is that unless we start breaking below, these levels here, 41.70, 42.60, whatever that happens to be, it's still going to be in an uptrend. I would have thought it's more likely than not that we trade up here and then come back down. It would be unthinkable, or improbable rather, that the S&Ps can do very much without the Nasdaq, without the biggest sector. To me, 13,816 is going to be a very, very important level on the weeklies, and 13,717 is going to be a very important level on the 195 minute, but anything up to 14,044, that is the area that I think you can think about arguing with it. But closes, if it starts closing above 13,816 and then coming back to 13,050 and so on, are going to be ultimately bullish. So to me, first touch of 13,816, it's a low risk short or buy some put spreads, and then we see. The VIX has been really the best indicator that S&Ps were not going to go down. The fact that we have been going down, and this is a weekly chart and I'll enlarge it for you, the fact that we've been going down in volatility for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks on the trot indicated to me that there was no real point in fighting it, and that anything that I hoped for on the downside really wasn't going to happen. So where can you think about starting to fight? What you want to do is look at what is going to happen around this 1750, 17 area, 17 and a quarter, whatever, anything down here, which leads me to believe, A, that S&Ps will get up to that 43.80 kind of level, but also what I'm looking for to even think about fighting the S&Ps is a NQ not breaking up beyond those levels that I just showed you, but also some kind of tendency of VIX to be going up even while S&Ps are going up. That would be the first divergence sign, that divergence of behavior sign that we've seen between VIX and S&Ps for like 3 months. VIX has been leading it down. VIX is likely to lead it back up. If VIX starts going back up, that will be the sign that really we are exhausting the possibilities in the S&Ps. The Nikkei seems to have led this, and it's broken out. This is the range between April and now. We've broken out of it above. I would have thought that it has to trade 29,400-ish. We're overbought on the weekly. We might do nothing for a week or so and then trade this 29,400, which is about here. And it's it's saying not yet. If you want to short it, basically it's saying not yet. If all it does next week is come back to 28,300 and basically screw around there, that is still going to be bullish. So what I'm seeing is, I'm not seeing volatility confirming anything. I want to see that first. I want to see the Nikkei basically showing signs of exhaustion on the upside, and it might do up here. And I want to see Europe calm down. And this is the chart of Europe. What a level that 38.83 was. And to me, we have to touch at least 38.82 or 38.43 on the weekly to think that we are anywhere near the exhaustion. So I think that we are likely to touch at least 38.43, if not 38.82, and that will signal that basically the stocks are getting to an overbought level and you can start thinking about a correction. And that would marry in with that level in the S&Ps around the 43.84 area. I do think we get there next week. In conclusion, I've updated all the levels. Really, in bonds, nothing much has changed. The only thing that could make me think that we're not going to reach 43.84 is a big move up in 30-year yields up to this 319, 322, but I really can't see it. I really don't think that that is what is likely to happen. And I'm waiting to be proved wrong, but if that 320 level in the 30-year keeps on being the top and we keep on trading back down to below 3, then the re-rating in the probabilities of recession, the down rating of it will continue, and we should continue to see a buy the dip mentality in stocks. Thank you very much indeed. Have a lovely weekend, and tweet you on Monday.